My name is Bryan Howell with Bank News Media, and it is my pleasure to host today's webinar, 2018 CFO Outlook for Financial Institutions, sponsored by Kaufman Hall, whose Axiom Financial Institution Suite provides sophisticated and flexible performance management solutions that empower finance professionals to analyze results, model and forecast scenarios, and optimize organizational decision-making. Axiom software provides solutions for strategic decision management, budgeting, planning and forecasting, funds transfer pricing and profitability management, reporting and analytics, and incentive compensation management on a single unified platform. As a reminder, this webinar is being recorded, and everyone registered will receive an email notification when it is available. We will have a question and answer period at the end of the webinar, so please submit your questions using the question function on your screen. Our presenters today are Bryan Ridgway and Brad Brockman, who are both Senior Solutions Engineers in Kaufman Hall's Financial Institutions Group. Today, they will be discussing the results, implications, and recommendations around 12 key findings from Kaufman Hall's recent CFO Outlook survey of CFOs and senior finance executives at financial institutions. Bryan?
Great, thanks, Bryan, and welcome again, everybody, to today's webinar. Does anybody recognize this picture from the Olympics? The U.S. athlete on the left is Chris Madser, the first U.S. competitor to medal in the single luge event ever. What's even more interesting to me is to note the top three athletes that made it onto the podium. The top two were within 2/100ths of a second of each other after 4 runs down the ice. So the difference between gold and silver was just 2/100ths of a second. Even more stunning is the fact that the fourth place finisher that was left off of the podium, that's not in this picture, and probably, quite frankly, not in any pictures anywhere for the Olympics, was just 2/1000ths of a second slower after 4 runs down the ice. So 2/1000ths of a second after 4 runs, and you have an Olympic medal or you don't. So was it these three men's mental preparation, better physical preparation? Did they have better coaching, a better team, better tools, better equipment? Did they have a better plan in place to execute and make their way down the track? Or did they just execute their plan better under a pressure situation? Why are the three of them on the podium and in this picture? Well, the difference between being a high-performing financial institution and being one that is just off the podium is just as close. And it really comes down to all those same factors that I just discussed: preparation, plans, leadership, teamwork, execution, tools, etc. So over the next 50 minutes, we're going to review and better understand the results from Kaufman Hall's CFO Outlook survey for financial institutions, and more importantly, the implications and recommendations related to those findings. Really working to identify how your institution can create a competitive advantage and get onto that podium. So in order to achieve those objectives, Brad and I are going to work through 12 key findings from the survey, grouped into the following 4 categories. The first is the readiness to manage performance in the current and certainly challenging banking environment. Secondly, we'll discuss the current status of performance analytics in the marketplace today. We'll then review the priorities specifically in the areas of budgeting and planning, and then the next steps toward achieving better performance management. And we'll finally then wrap it up with a quick recap and question and answer period that Bryan mentioned previously. So let's start with a little bit of background information about the survey. So Kaufman Hall conducted the survey for the 2018 report in October of 2017. And the survey consisted of more than 30 questions, and executives from more than 100 institutions participated. And of those, roughly 67% were from banks, about 23% were from credit unions, and the remaining 10% were from a combination of farm credit associations, non-bank lenders, as well as other financial institutions. So the asset, from an asset delineation standpoint, really had a broad representation here, with approximately 72% of respondents coming from financial institutions over $1 billion in assets, and just under a quarter of respondents coming from institutions less than $1 billion in assets. So with that, let me go ahead and turn it over to Brad, who's going to walk us through the first category of questions and findings from the report. Brad?
Thanks, Brian. So as Brian mentioned, we've broken the survey down into 4 categories. And the first category that we're going to focus on is readiness to manage performance in the current environment. So let's begin with our first topic. It deals with the CFO's limited confidence in their institution's ability to manage impacts of changing business. These changes could include regulatory changes, operating changes, changes in rates, all of which have significant impact to the business. In our first survey question, we asked, if business circumstances change suddenly, how confident are you in your team's ability to quickly and easily make adjustments to financial strategies and plans? As you can see here, only 35% are very confident in their ability to make changes to these financial strategies. When asked overall, how satisfied are you with your performance management reporting at your institution? We see here only 13% are very satisfied with their management reporting, leaving a lot of room for improvement in these processes. So what we're looking at here is a scenario analysis. So we have the ability here to run different scenarios, uses changes in some of the factors that I mentioned earlier, growth assumptions, changes in rates, and then viewing those scenarios on the bottom bar charts next to each other to better understand the impacts. In this case, we're looking at loan interest income. The role of finance executive really centers on building institutional agility and preparing for changes and new conditions. The limited confidence in the ability to respond to business changes points to a vital area for needed improvement in all financial institutions. As indicated by our survey, only 13% of respondents being satisfied with their management reporting. It's very difficult for leaders to accurately assess their institution's performance and respond to change under these conditions. Modern performance management techniques and systems can be used by the finance team to position the institution to respond more nimbly to anticipated and unanticipated changes. So some of the techniques include that you'll see here: scenario modeling, profitability measurement, cash flow forecasting, and more. Institutions must be equipped with business technology and processes that enable financial professionals to evaluate and revise their strategies as needed. Decisions from finance leaders, derived and supported through reporting and scenario analysis, must be timely in response to changing circumstances. So in our second finding, this centers around finance executives' desire to do more to leverage data and improve decision-making. So finance executives want to do more to leverage data and analytics to improve their decision-making. Well, the results tell us that 91% are experiencing increased demand in correlating their financial results and the impact to the business strategy. 84% say their institution should be doing more to leverage data and inform strategic decisions. CFOs must ensure reporting of comparative benchmarks. So benchmark-rich database and analytical tools are now a critical element in the successful operation of financial institutions. 87% of respondents recognize the importance of this activity, yet only 60% say their institution is performing benchmarking against industry data. So what we see here, this is a peer analysis focused on industry metrics and how a sample organization is performing versus a peer group. As we look down to the center of the slide, you'll see that the net interest margin is lower than anticipated. We're much lower than the industry benchmarks and the peer groups that have been selected. So how do we take action from our peer analysis? With the acknowledgement that our interest margin is lower than the peer rates, what we're looking at here is a deeper analysis, and this focuses on our risk-based pricing. At the scatter plot on the bottom, you see we've charted here our FTP spread versus credit scores, so leveraging some additional external data. We see here our pricing is really all over the board. It's not in line with our risk exposure. So by leveraging external data and including this analysis, this should really push our organization to review our pricing policies with the goal of a better net interest margin and more aligned to our peer group. With a seat at the strategic decision-making table, CFOs and other finance executives in financial institutions should bring analytics-based insights regarding the financial impact of initiatives to all conversations. Responsible for significantly more than reporting, CFOs are integral to the development, the execution, and the monitoring of the organization's vision and strategy. So our third set of findings is under readiness to manage performance is about the need to measure profitability across multiple dimensions. So our survey asks, what statement best describes your profitability, analytics, and reporting? And if you notice here on the upper left-hand side, we see that only 16% of respondents have a clear understanding of profitability across the dimensions of their business. Our next survey here, CFOs need to measure profitability across multiple institutional dimensions. So the majority of respondents, more than 88%, agree that monitoring the dimensions of profitability is important, yet only half of the institutions report doing so. This is an example of a profitability dashboard that really enables us to monitor profitability by any dimension of the business. So in today's volatile and ever-changing operating environment, determining those key profitability drivers is really mission critical for any financial institution. With compressed margins and increasing competition, it's imperative for financial institutions to understand how customers, branches, channels, officers, and products contribute to their bottom line. If finance executives do not understand their institution's profitable drivers, it's difficult to make informed decisions about where to invest resources and how to capitalize on opportunities. I'm going to hand it back to Bryan now as he continues to share more results from our CFO survey.
Thanks, Brad. And so for the next set of our findings and survey-related questions, they can be categorized into this heading, the current status of performance analytics. And so our fourth finding in our report is that financial institution CFOs want and need access to enhanced data, along with the ability to perform high-quality financial analysis and reporting. And so along those lines, we asked CFOs what were their biggest challenges with respect to being able to perform the reporting and analysis that they need to effectively run their institutions. And here are their responses. So first and foremost, 65% of the respondents indicated that their largest challenge is due to the disparate nature of the data that they need to perform that analysis. So they have data that's located in multiple applications, multiple databases, perhaps even stored out in Access or Excel in all these different locations. Additionally, more than half of the CFOs want the ability to better present and visualize data through dashboards and graphics, as well as have easier access for report creation for not only themselves, but certainly for their teams. And then nearly half of the CFOs that responded continue to struggle with challenges related to having the necessary data in a quality state to leverage as part of that reporting and analysis process. So that quality of data continues to be an issue for the industry as a whole. So what does this really mean? Well, it means that CFOs are continuing to struggle to provide the data and analysis that they, as well as the rest of the organization, need to most effectively make those strategic and tactical decisions. And we think it's imperative that financial institutions put a priority on addressing those top four issues. You need to spend the time, the money, the effort to provide the data, the analysis, and ultimately the information that enable your people across the organization to make better decisions. So more specifically, we recommend that you analyze and look at your current financial performance management processes to determine the best way to consolidate all of that information into a single unified platform and data mart or data warehouse. And then as you look to consolidate and optimize your performance and analytics focused on that single source of the truth, all in that one location, you and your teams really should be looking to address those other top challenges. So as you're looking at the data that needs to come into that single location, address the quality of data. And we recognize that can't all be done at once. That's a large task, but making progress over time as an evolutionary process is going to ultimately lead to the benefits that you're trying to achieve. And then secondly, make sure that you're providing your team as well as the rest of the organization with a reporting and dashboarding framework that not only enables the needed analysis of the data, but also provides that data visualization and graphing, as well as the ease of use that you, as well as your report consumers, require. So what might this look like? Well, here's an example of a branch manager dashboard, and this could be for any department manager, any line of business manager, product manager, whatever that might be. But here's an example of pulling all of that information and consolidating it into a single view based on the fact that I have it all in one location underlying my reporting and dashboarding framework. So this provides me as a manager a quick visual snapshot of how my responsibility area, my branch in this case, is performing, including different components around KPIs. So we've agreed upon with the organization, what are those critical KPIs that I should be tracking as a branch manager? Also includes information around profitability, in this case down to the customer level. I can see my top customers, but I may also have different profitability metrics that I might want to include in my view. Also providing links to other dashboards or reports. I can't fit everything on one screen, so providing those additional links to, in this case, production type reports. How many new deposit accounts did I open? What was my balances that I grew for certain loan categories, et cetera, as well as information around my financials and perhaps variance reporting around my budget to actual performance. So I have a one-stop shop to go to get all of the information that's critical to me as a branch manager to make the decisions I need to make. So again, the key components are really having a single source of data that can be leveraged and easily consumed by people in the organization, and providing them with that information when they need it in a way that's easy for them to use as well as interpret. So our second finding in the category of the current status of performance management, and our fifth finding overall in our CFO Outlook report, is the need to ensure a complete picture of profitability analysis, including below the line costs as well as above the line margin analysis. So in today's challenging banking environment, the ability to understand the drivers of your profitability across all levels of the institution is critical, just like Brad talked about before, being able to analyze that at the customer level, the relationship level, the product level, so on and so forth. But it's as equally important to make sure that your analysis of profitability includes both the cost components, the below the line components, as well as the margin components, to ensure that you have the accuracy of the information to support the decisions that you want to make as an organization. So along these lines, we asked the CFOs in the survey two key questions. One is, first, is your institution utilizing cost allocations, unit costing, or activity-based costing to better calculate, to better measure, and ultimately to better analyze profitability across your product, customer, and other segments of the financial institution? And only 40% indicated that they're doing one of these levels of analysis related to the below the margin costs. So yes, gaining a deeper understanding of costing does require the use of additional metrics and information. It includes transaction volumes around the number of deposits or loan advances or ATM withdrawals. Also driver values, perhaps the number of accounts opened or the number of calls into a call center, or things around, head count, those types of information. And then also cost allocations that are going to align the operating expenses with the drivers through different either cost surveys or potentially, if you're getting down to the activity level, even cost studies. And then ultimately assigning those costs to the institution's organizational units, the products, the customers, and ultimately down to the individual account or instrument level. So current approaches to cost allocation vary widely, and we had about an equal proportion of survey respondents using each of the three types of allocation methods listed here: driver-based, percentage-based, or activity-based costing. But a larger proportion indicated that they're actually seeking to improve their cost attribution process using a more detailed costing approach. So people are looking to make improvements beyond what they're doing today. So we also asked CFOs if they're utilizing funds transfer pricing to better measure and understand the drivers behind their net interest margin. And while 65% of institutions indicated that they are in fact leveraging transfer pricing as part of their profitability analysis, only 40% indicated that they're using matched term FTP, where margin is actually calculated at the individual instrument level, which ensures the most accurate measure of the net interest margin that then can be aggregated and analyzed at any other level of the organization, because I've done it at that lowest level. Well, to gain a complete picture of profitability, which is going to better allow you and your teams to manage your overall margin, what we found is that successful institutions really start with the largest component of profitability, net interest margin. And by allocating the institution's net interest margin to the individual instrument level using matched term FTP, you're taking the most accurate approach to measuring that margin, which is absolutely critical for financial institutions, as typically margin represents anywhere from 60 to 80% of net revenue. So let's take a look at a sample profitability statement for an individual customer, in this case, for the institution, and really look at two key elements here. First is, in order to measure and analyze profitability across all levels, including customer center, customer officer relationship, you'll eventually need to have a process that measures profitability at the individual account level, from which you can then aggregate to any of those other levels in the organization. And what we can see here on the right is a profitability statement down to that individual account level for these two loan accounts that Luna Company, our sample company, has with the institution. And then secondly, you want to ensure that you're accounting for all the components of profitability, including the assignment of FTP and income and expense, as we talked about, by calculating that FTP rate using that matched term approach. Also accounting for indirect costs and applying those and attributing those through a unit costing approach, as well as direct expenses, making sure you're accounting for direct non-interest income, as well as then the allocation of the provision expense, as well as the allocation of capital. So this detailed and granular view of profitability that we're looking at here on the screen is going to ensure that you're making decisions based on both accurate as well as defensible assumptions, as well as provide consistency of information regardless of the level of profitability analysis you're doing in the organization, because you're aggregating it from the lowest level on up. You can then truly understand those primary drivers of profitability that Brad talked about before and really leverage that information to make better decisions for the organization. And that brings us to our next finding, which is that many profitability initiatives in the past in the banking industry have failed primarily due to one of two reasons. One is either the process became too bogged down in the details regarding those cost allocations and attribution rules. The process just got caught up in the politics where you couldn't come to agreement about those costing rules. Or the results that were generated from the profitability process were never actually leveraged for their full capability. Profitability data was just viewed more as a nice to have. It's interesting information, but it wasn't being leveraged to make decisions in the organization. So one of our findings from the survey result is the need to better leverage profitability results in other processes in order to improve the performance of the institution and ultimately to make profitability matter across the organization. So in other words, focus on the usability of the results as a priority over the accuracy of the process. So the use of profitability information by your frontline employees can not only help improve overall profitability for the institution, but it can also help inform your customer interactions, your policies, and your processes that are going to enhance that customer experience. And at many financial institutions, the contribution to net income by the top 1% of your commercial customers typically exceeds the contribution of the bottom 50% combined. So knowing the value of the customer's relationships for your most profitable customers is absolutely critical, not only for you, but perhaps more importantly for your frontline personnel. And so our survey results indicate that the majority of CFOs, roughly 82%, recognize the importance of the loan officer's ability to evaluate profitability as they work on new deals or propose new loans or accounts for their customers. But only 17% of the institutions actually have a mechanism in place that allows their loan officers to actually assess and understand the impact to profitability of those new deals. So as we discussed previously, the ability to calculate profitability at that individual account level provides numerous benefits. Well, an additional benefit here is that this information can now be available in real time to customer-facing personnel, such as your loan officers or your relationship managers, when they're making pricing or other decisions specifically for the customer that's sitting there in front of them. And so in many cases, this can be leveraged as part of an account pricing system to ensure that the proposed deals are structured in the best way, not only to maximize the results for your customer and meet their needs, but ultimately to maximize the results or the performance for the institution. So what we're looking at here is an example of being able to simulate the impact of adding a new account or new accounts for a certain customer and the impact on that profitability for that full relationship. So that way the loan officer can fine tune and structure the deal as they need to. So in the top here, we have the existing accounts that this customer has with us. Down on the bottom left, here's the proposed new account. Combined with the existing account, here's the impact on the full relationship. And ideally then the ability to change the proposed deal structure in order to understand that impact, not only on that new account, but the full relationship that we're talking about here. So in addition to that, profitability analytics also, we feel, deserve to be front and center within your incentive compensation programs. So a well-designed profitability-based incentive plan is going to help align your employee behaviors with your bank's overall strategy. Yet only 42% of the respondents include profitability as a metric when they're calculating their employee incentive compensation. And my guess is in those numbers, many respondents were referring to overall institution level profitability as opposed to more individual department or perhaps line of business profitability. So yes, we are seeing progress in this area, but the pace I think is a lot slower than many people had expected. And so incentive compensation historically has been often either primarily or solely tied to loan or deposit volumes and metrics associated with volume growth, such as the number of referrals or accounts opened. But the banking crisis of the past decade certainly made it clear that not all growth is good growth. And adding loan volume without considering risk as well as profitability certainly may be a recipe for disaster. So the data and the tools that you already have available as part of your financial performance management systems really can and should be leveraged to help you develop and structure and manage your profitability-based incentive programs. So in the interest of time, we actually won't be showing an example here of using profitability in incentive compensation process, but hopefully based on that brief conversation, you can understand the importance of that discussion. And we do have additional resources available on our website specifically focused on this topic. At the end of last year, we did 3 blogs as well as a recorded webinar on the topic of including profitability in the incentive compensation management process. So for looking for more information there, certainly can go out to the website and see that. So with that, let's go ahead and move on to our third category of findings in the report. Let me turn it back over to Brad. Brad?
Yep. Thanks, Brian. So in our third category here, we're going to focus on some findings around priority areas in the planning process. And we'll begin here with a focus on the long budgeting cycles and therefore the lack of time for value-added analysis. Our first response that you see here tells us that 75% of institutions take 3 months or longer to complete their budgeting cycle, and 40% say they do not have ample time for value-added analysis. And here we see that standalone spreadsheet-based budgeting remains all too common. Nearly 1/4 of respondents are still using spreadsheets as their primary budgeting system. So as a recommended best practice and an approach to planning, the recommendation is really an integrated planning cycle. This is an active tool that's used for day-to-day performance management. It provides precise guidance to all levels of the institution and is used regularly to provide direction and focus. A truly strategic budgeting process, fully integrated with the institution's strategic planning processes, their reforecasting processes, and the performance assessment, should only take 2 to 3 months to complete. The protracted budget cycles eliminate valuable time for analysis and insight. All too often, the budgeting process is trying for financial managers, consuming up to half the fiscal year. As a result, the budget development period is much longer than 3 months. It makes it difficult, if not impossible, to add valuable analysis and insights that might support, for example, an adjustment to the budget to reflect changing financial conditions. So in our 8th finding here in our study, we'll take a look into capital project planning process and the challenges that it represents. So our survey data indicates CFOs are having a difficult time with their institution's capital project planning and management process. This graph notes the top challenging aspect of the process is with monitoring the financial impact of projects after their completion, topping the list you see here at 28% of respondents. When asked whether monitoring of the financial impact of completed projects actually occurs in their institution, the results shown here provide cause for concern. 60% of responding CFOs say that the important aspects of monitoring of a completed project is not occurring in their institutions. So what are we looking at here? Shown on the screen is an example of a capital project request form. This is a form that can be used to submit capital projects, including income benefits, expenses, and funding for the project. If approved, this data can then be tracked against the execution of the project, expected benefits, and expenses as well. The lack of consistent information regarding capital requests make it difficult for leaders to determine which projects to approve and which projects to fund. Given the high price institutions pay for poor investment decisions, inconsistency in data and analytics surrounding the capital request process really increases an institution's strategic, financial, and operational risk. After the executives make a capital project decision, ongoing and disciplined monitoring is vital to ensure the actual capital spending and performance targets are met by the projected levels, and leaders have visibility into where variance may exist and why the variance exists. So in another priority area in the planning area, this centers around improved balance sheet planning, including forecasted FTP, as Bryan mentioned earlier, the cash flow forecasting process, scenario analysis can really increase the understanding of our organization and of our performance in a volatile operating environment. So which items are currently included in budgets? Budgets really should be informed by a wide range of planning and analytics initiatives. This graph here shows the portion of respondents who indicate which balance sheet planning items were included in their institution's budget. So only half of respondents are including FTP or funds transfer pricing, really enabling that more detailed margin plan. Only 49% are including cash flow-based forecasting, and only 41% are doing scenario analysis. So some recommendations here around the planning process. One of the recommended approach that really adds forecasting accuracy and precision is a cash flow-based planning process. This is currently used by only 49% of the represented institutions. Such planning really enables a financial institution to forecast the existing instrument level record and new growth into cash flow streams and the ability to aggregate them in multiple dimensions of the business. This yields a much greater degree of precision as banking professionals take into consideration the variables such as interest rate forecast, prepayments, runoff on existing balances, and the impact of new originations or growth of the organization. The second recommendation here is a forecasted FTP, which is only used by 50% of the representative institutions. With FTP forecasting, the finance team can create a standard measure across markets, between teams for profitability and margin management. So this approach really enables those finance teams to make them better able to assess actual performance, including the spread, the interest income, and the expense across the organization. And the last recommendation is the ability to run different scenarios. So testing the impacts on deposits, loans, and credit is part of the budget process, really enabling the institution to run multiple what-if scenarios, be better prepared for volatility, even better prepared for unforeseen environments such as in a stress type scenario. So in the final finding here in this series, we're going to focus on rolling forecast. And from our survey, we see here the use of rolling forecast to supplement the budgeting process. I think what's most interesting is that only 42% of respondents are using rolling forecast as part of their budgeting process. So the rolling forecast can really bridge the gap between an operating budget and a long-range financial plan. For example, if things start to get off track in year 2 of the long-range plan, the rolling forecast enables the finance team to effectively identify the current position relative to targets and efficiently forecast based upon the evolving needs and changes in the business. This really extends the look, transforms executive and finance teams' conversations from a dialogue focused on variance from budget and explanation to focus on actionable short-term goals for performance improvement. How do we get it back on track? How do we improve our overall performance? Here we see the ease of identifying and tracking that gap here in the financial performance using this approach. So the recommendation here is that the rolling forecast really offers a way to stay agile in a dynamic environment, the ability to identify and adjust strategies to meet those market changes in a volatile and ever-changing environment are very important. Well, Brian, I'm going to hand it back to you to bring us home.
Great, thanks once again, Brad. And so really in order to implement many of these different recommendations and to continue to improve performance results at your institution, really need to regularly review and assess your focus, your processes, your tools, really trying to take the next step toward better performance management, which is our last category of our findings here. So along those lines, our 11th finding from the survey results is that the process of continuous evaluation as well as improvement really needs to start from the top, with strong and effective leadership coming from the executive level. So if CFOs think about where they need to make improvements and gains in their processes, there's certainly no shortage of opportunities for improvement, specifically in the areas of performance management. And as shown in the breakdown of their priorities here from an improvement perspective in our survey. So given the many pressures then faced by financial institutions in today's challenging environment, the foremost priorities that were reported by the CFO respondents were: 1, improved budgeting and forecasting. And 2 is the ability to measure profitability and assess profitability across all dimensions, as Brad talked about earlier. Also support better analytics and reporting to support better decision-making across the organization, and then ultimately better management and efficiency around the cost management topic. So interestingly enough, these top 4 improvement areas, which really form the foundation of sound financial performance management, are consistent with those identified from the respondents from last year's CFO Outlook survey. So those priorities haven't changed. So it is consistent as we look and evolve across time. So what do we recommend then out of this? So specifically, we recommend that finance leaders be committed and involved in achieving better performance management processes, and not only being committed and involved, but really leading your organizations in this area. So this process spans strategic planning, budgeting, and forecasting, as Brad just talked about, profitability management, reporting and analytics, all of really the additional activities as well centered within or coordinated through your institution's finance or perhaps even accounting teams. So while progress is being made here with all these functions, it's critical that CFOs and finance leaders focus on the areas that are going to generate the most significant returns for your institution. So really spend that time to analyze, what are we trying to achieve and what's our best way to achieve that from a process perspective, and let's focus on the items that we think are going to have the best returns for us. So really though, regardless of where your institution starts in this process, leadership really needs to be provided throughout the improvement process, starting with what I just talked about, very clearly defined and communicated goals, vision, and requirements for those improvements. And then providing that leadership through a disciplined and structured approach as you analyze the resources that you need, the resources that you have, and potentially even your tool selection process, as well as leadership throughout the implementation and rollout process, really providing that guidance not only for your team, but the rest of the organization as you look to make those improvements. And then the final finding from our survey is that it is imperative for financial institutions to ensure that they have the necessary results, the necessary data, and the necessary tools, essentially all of the resources needed to support those desired process improvements and ultimately the performance gains that you're trying to achieve. And so here we asked CFOs what their top challenges were with them being able to achieve their goals in the performance management processes. And the number one response was being resource constrained, with about 61% indicating that they have resource constraints. Number 2 was having outdated processes. And then number 3 was having inadequate tools, around 44% there. So interestingly enough, as I looked at this information and really tried to understand what it meant, I actually look at those top 3 challenges, and I think they're actually related and intertwined to some degree. So if you step back and think about it, if you can design an effective performance management process with very specific goals in mind for your organization, that can help provide the focus and the priority for your resources that you do have already on staff to focus on those most important items. And then as you think about improvements to those processes or new processes that you implement to make the gains that you want to make, you'll also want to make sure that you have effective tools that are going to allow you to meet the needs of those processes. And then bringing that full circle, if you spend the time and the money on tools to support those processes, as you're doing so, look for tools that are also going to improve the efficiency of those processes. Because if you can improve the efficiency and provide automation around those processes, ideally you should be able to accomplish more with the same number of people, because the tools can do a lot of the heavy lifting for you. So really what many people can't afford to do, or many institutions can't afford to do, is just keep doing what you've always been doing and expect different results. So we really recommend that you identify and tackle your institution's challenges head on by ensuring that you have well-defined processes with a vision of where you want to go, that you have the right tools and the right people in place in order to execute upon those goals. So with those 12 findings now covered, I'll take a couple minutes here and really summarize those findings into actionable steps. And then we'll go ahead and provide a quick recap before we go ahead and open it up for any questions that may have come in. So as you're all certainly keenly aware, performance management within the financial institution industry is an exceedingly complex endeavor. And again, that business environment that you're operating within is very challenging. Calls for cost controls, increased regulatory requirements, challenges around low interest rates, et cetera, right? Well, the call for action for CFOs and their finance teams is clear, right? Action has to be taken, and it is being taken. But the specifics of that call are a little bit less clear. And so as we looked at all the results and the responses to the survey and the data, we've identified 7 actionable priorities for you to take away and consider back at your institutions. So number 1 is you all have access to more and better data than you've ever had before. So ensure that you're using that data and analytics to make better decisions across the organization, not only in your teams, but other teams across the organization. How can they leverage the data that you have available for them to use? Secondly is to better understand and measure profitability and its drivers to ensure that you're not just growing for the sake of growth, right? Let's get away from that mentality, but that's you, and I think perhaps more importantly, that everyone in your organization is focused on profitable growth. Number 3 through 5 here are all really focused around the entire budgeting and planning process. So number 3 is consider planning those large-scale capital projects as separate and distinct items, as Brad talked about, where all of the capital and the expenses and the headcount considerations can be grouped into a single multi-year project, not only for planning purposes, but also then can be tracked from an execution standpoint, really providing better transparency and planning into your biggest project and some of the bigger decisions you need to make as an organization. Number 4 then is utilizing scenario analysis to evaluate your plan and your budget under different business conditions, really looking at both external business conditions and internally driven changes in business conditions. And then update your plan periodically by reforecasting based on changes to those environments. Again, that section that Brad covered, really ensuring that your team is not only ready to survive, not if, but when the business environment changes, but they're actually ready to thrive in those different business environments. And then number 5, look to shorten those lengthy budget cycles, right? 2 main considerations here. 1, look for opportunities for efficiency and automation in that process. But perhaps more importantly, consider viewing your planning, your budgeting, and your reforecasting cycle as that single continuous process that Brad walked through. Then number 6, assess your current performance management processes and make sure that your processes are designed with your institution's specific end in mind. What's your vision? What are your goals? What are you trying to achieve from those processes? What decisions are you trying to make with the information that's coming out of those processes? And then make the necessary adjustments as you evolve and mature in those processes to make sure that not only you and your team, but the institution is achieving its goals. And then finally, ensure that you have the tools in place to achieve the items identified in 1 through 6 here on the slide. And most importantly, not only to achieve 1 through 6, but ultimately to achieve your goals as an institution. So if you recall, Brad and I worked through this agenda where we covered the 4 categories of findings from our CFO Outlook survey and report in order to meet our objectives for today's webinar. And so I hope that we were able to meet these 2 primary objectives for today's session, as well as ideally provide you with some specific takeaways for you to consider and discuss at your organization and improvements that you might want to consider and make as an institution. So with that, let me go ahead and turn it back over to Bryan from Bank News to guide us through any questions that might have come in throughout the webinar today. Bryan?
Okay. Thank you, Bryan. Thank you, Brad. And as a reminder, in order to submit your questions, please use the question function on your screen, and as they come through, we'll have Bryan and Brad answer those questions. Bryan and Brad, we do have a question that just came through. A lot of good information covered, but if you had to boil it down to a single recommendation, what might that be?
Yeah, I think I'll take that one, Bryan.
You want to take that one, Brad? Yep, good.
Yeah. So I really, recommend placing a high weighting on flexibility. So what do I mean by that? We talk about a single platform really that's flexible enough to allow an organization to start with any process that they wish to start with. Right? So where do you see the most, return? Focus on starting with the end in mind and then working back. But it's important that the system and the processes are flexible enough to really start you at any level and allow you to expand and grow as you mature those financial processes. The second aspect, I think, is around the data. So again, when I think about flexibility, it's not just around different processes, but around the data. So the ability to support very granular level transactional data and processes, as well as the ability to aggregate that data so that you can show aggregate views of performance and allow management and decision making for the entire organization at that level as well. So I would think, those two I think are very important, flexibility and kind of two different flavors there.
Yeah, Brad, this is Bryan. So a couple of great points there. And I might, as I think about that, I might also want to add in, I think, an additional item, which is really having the goal of enabling the people from across the organization to make better data-driven decisions. So we talked about that, I think, multiple times and referenced that. Providing information to people across the organization, not just keeping it centralized within finance. And so in providing the data that they need to, like I said, make those better data-driven decisions. I don't think you necessarily want to replace your gut feel with just data-driven decisions, right? It can't all be about the data, but I think it's really being able to support that gut feel with key metrics and data from those processes, and really, combining those two is critical in my view.
Another question just came through. A lot to think about here. If we are just starting to look to make improvements, where do we start?
So, Brad, you want me to take this one?
Yeah, go ahead.
Okay. So where do we start? I think, again, and I think we referenced this in a past webinar and brought it up a couple times today, which is really starting with that end in mind. What is it that your institution is trying to accomplish through your performance management processes with the additional data and the additional insights that you're looking to have? As I mentioned, what decisions are you trying to make and support across the organization? And then really work backwards from there. So once we know what decisions and how we're going to leverage that information, what processes do we need to support that? What metrics and information do we need to support that? What people and tools and other resources do we need to generate those metrics and information? And then really working backwards and ultimately getting back to the data, and what data do we need that has to go into those tools and processes to support that full process. Does that make sense?
Yeah, I think, Bryan, I think I would add something on here as well. I think it's important that as you look at these performance management processes, whether that's profitability, budgeting and planning, forecasting, incentive compensation, many of which we mentioned and talked about in our survey results, right? I think it's important, not to be overwhelmed, focusing on a particular area or a first step for those that are maybe getting started, and realizing that this is an evolution and a maturity, that as you grow, you become more mature and get more sophisticated in these processes and tools. It certainly helps to have a vision of where you want to go, but certainly don't be overwhelmed and thinking that you have to accomplish everything at the onset. It can certainly be broken down into manageable pieces.
Good. And we have time for one more question. And that last question is, as you talk about the different findings, one big question that came to mind is this a BI? Is this performance management? Is it something else?
Wow. Okay, Brad, you want me to tackle this one as well?
Go ahead.
Okay. So is it PI initiative? Is it performance management? I would say yes and yes. It's really, I think, a combination of performance management to support all of those different financial and operational, planning and metrics needed to make decisions, right? So whether it's profitability or budgeting and planning, there's certainly that performance management aspect where you have to calculate the different metrics and the information that's needed to support your processes and your decisions. But I think there's also very much a business intelligence component to this. I think we saw in the survey results, one of the top needs from a reporting and analytics standpoint is the desire to have better data visualization and graphing and dashboards. So really thinking about how do you disseminate that information, that data, those results across the organization? Are they static reports? Are they drillable reports? Is it dashboards and data visualization? And so really thinking about it as that combined view. And I think ideally being able to optimize that by having a process and the tools on a single database, single platform that we talked about that's going to allow you to accomplish both elements, the performance management and the BI component of that, in the most efficient and effective way possible.
Excellent. Well, we don't have any more questions at this time, so at this time we will conclude today's webinar. Bryan and Brad, thank you very much for these excellent presentations that you gave today. Thank you all for your attendance and participation.